the COVID-19 pandemic has changed the way Filipinos consume goods and engage in services as it puts a plug on economic activity. The result of which is steady inflation settling within government target. Now the downside, though, worse than expected consumption levels. Inflation picked up in January this year following typhoon damage to crops and the Taal volcano eruption. The figure began to dip soon after, mostly driven by the onset of the pandemic. During the first months of the health crisis with lockdowns in place, inflation settled in the low end of government's 2 to 4% target before picking up in July due to increase in transport costs. Households resorted to limiting their purchases to essential items in order to preserve cash as work and businesses were affected by quarantine measures. In November, inflation accelerated above 3% due to massive agricultural damage from back-to-back typhoons. Combined damage from typhoons Quinta, Rolly, and Ulysses had been estimated at 12 billion pesos. The three most affected regions were Cagayan, Calabarzon, and Bicol. And even as the government moved to ease restrictions later on in the year, household spending wasn't quick to catch up. Metro Manila has since been downgraded to the second least restrictive category, GCQ, in order to drum up consumer confidence. Progress over COVID-19 vaccines also came in the last few months of 2020, sparking optimism and later on a market rally. However, this wasn't enough to push consumption. Market analysts and economists were in sync in commenting how the central bank did most of the heavy lifting this year, firing monetary stimulus after another. As for the fiscal side, the general sentiment was that it seemed lacking. The Bangko Sentral ng Pilipinas slashed key rates by a total of 200 basis points this year in hopes of cushioning the economy, which plunged to a technical recession in the second quarter. The cumulative reductions had offset the series of rate hikes the central bank implemented in 2018 to ease inflation. Benchmark interest rate is now at 2%, while overnight deposit stands at 1.5%. Lending facility, meanwhile, was reduced to 2.5%, all during a surprise cut in November. The BSP then kept rates steady during their last policy meeting this month, but this is seen as a temporary pause. Analysts expect the central bank to maintain a dovish stance in 2021 to support recovery and to utilize untapped liquidity. Banks continue to be challenged in the third quarter with asset growth slowing and a decline in issued loans. Bag loans grew 35% quarter on quarter to 287 billion pesos and was up 80% compared to the figure in the same period in 2019. But the government is hoping to turn things around next year. The BSP revised its inflation expectations upward this year and in 2021 while keeping its 2022 outlook unchanged. The projections still fall within the 2 to 4% target band. This comes alongside government's push for a rebound of 6.5 to 7.5% in 2021. The central bank is expected to continue its accommodative easing next year, dragging real interest rate further to negative territory.